Okay, good day, everybody. This is Jim Kinney for the OptionProfessor.com weekly market update. Of course, this is March the 8th, and that's 2019. As I say in the beginning of every report, past performance is not necessarily indicative of future results, and short-term trading, option trading, does involve substantial risk of loss. So, again, it's not right for everybody, so do consult your advisor, your clearing firm, the guy you're doing business with, and your good common sense before you get into any type of activity. Now, background on myself. Some of you guys might be new to the broadcast, so I'm going to introduce myself. I'm Jim Kinney, graduate of Boston College, been in the investment game for decades, and I have educated thousands upon thousands of investors at hundreds of seminars, the uses and the risks of option trading and using options for a variety of purposes. Would it be for cash flow or income purposes, or be for hedging, meaning protecting yourself from market declines like we're seeing today, and also for limited risk speculation? So there's a lot to learn on all the different fronts. I'm going to go through a bunch of different markets here today, as I do every week. People looking for income, I'll be looking at the bond markets. People looking for growth, I'll be talking about stock. And people that are comfortable with speculation, I'll be talking about gold as well as the US dollar. Okay, so here we go. Let's get started. What's the big news today? The big news is the unemployment report. And what did it show? The unemployment report showed a very paltry 20,000 jobs created last month. And of course, that is a big drop off of the 300,000 number that had been seen. So there is something going on there. But 1 month does not make a trend. 3.8% is the unemployment rate. That's near a 50-year low. So pretty much everybody's out there working. Not only are they working, they're making more money according to the wages. Wages were up 0.4%. They were expected up 0.3. That's a 20% almost increase, higher than what they expected. So it's a pretty good bump in earnings. Again, I've been a believer that the earnings are going to pop, which is going to make the inflation pop, which is going to make the bond market pop. That's basically what I've been thinking. The bond market hasn't popped, but certainly the numbers on wages are starting to show some inflation. Again, they're trading 3.5% to 4% growth year over year, and that's much higher than the Fed funds rate. And again, if inflation gets above the Fed funds rate, it can be very dangerous for the bond market. We'll have to see if that's going to happen or not. But that's what I'm thinking may happen, and there's no evidence that I'm wrong on it, so I'm going to stick with my theory on that. What else is going on here as far as the jobs report? Basically, the U.S. consumer, now people are questioning after the December retail sales were way down. You know, consumers are 2/3 of economic growth, right? So they got to keep spending or this thing's in trouble. Now, they are questioning whether they'll keep spending if, in fact, the jobs are all dried up. How much faster will spending happen? That's a question mark. The other thing here is Draghi over in Europe. Definitely lowering expectations over there. So we're looking for slower economic growth out of Europe. As he says, the risks are tilted to the downside in Europe. Government shutdown may have played a factor in weather. I'm not in the worst weather in the world where I am, but weather has been whacking the country pretty hard. And obviously that can hurt some of the economic numbers. And the government shutdown. Obviously, that's another factor that could have come into this 20,000 job number. So you got to be careful. But the slowdown in the jobs was across the board: healthcare, health services, education, leisure, and construction was down 31%. 31,000 jobs. And so there was kind of weakness all around. So you got to be a little bit careful. We'll have to see if it continues. U6, which is the underemployment rate, plunged 7.3%. That's the lowest since 2001. On a bright note, new home construction was up in January after a pretty weak period. And building permits hit a 9-month high. So basically, there's a little bit of a stabilization in the construction situation. Again, I'm going to just reiterate things that I've been saying. By the way, if you have other people you know who are in the market and would like to get details on what's going on from my vantage point, my opinion, again, tell them how to go to the website, OptionProfessor.com, and get the link. And also shoot me an email if you have any specific questions on anything that I cover here today. That email is optionprofessor@gmail.com. Okay, let's get into it here. The Dow Jones, as you can see, let me refresh the screen, see what's going on currently here. But the Dow Jones was getting hit, obviously, because they're concerned about that job number. the trade deal that may or may not happen and all the rest of it. But at any rate, if you've been listening to me and my broadcast, when we were down at 2350, I was indicating that the people that I've been reading and listening to we're thinking we're going to go back towards the 200-day average. Well, every pullback should have been bought during that period because we went not only to the 200-day average on the S&P, which is 2750 area, but we went through it. Now, once we got up to that 2750, I looked for other sources of information to try to get an idea of what the lay of the land is from this point, because we did blow through the 200-day. And then I started looking at some of the Elliott Wave guys who indicated that they thought it would go to 2820 area, which is exactly where it hit, with an outside chance of running at the high, 2940. Well, as I said earlier last week, if we start taking out last week's lows, which we've done, and the VIX can jump above 17 and stay there, then a more protracted decline may very well occur. As I was saying, as we went over analyze your trade on Tuesday, you know, there was a situation where most of the companies that I was seeing people show us had a 200-day average and a 50-day average that was still inverted to the downside. So I told everybody that the technicals basis the moving averages were a mess. And when they're a mess and you've had this kind of a jump up out of the blue, like we did, that the likelihood of sideways and even a decline is the most probable outcome. And again, that's what's been happening. So that was spot on. Again, you've got your line in the sand now, 2820, which was the rally high. And now you've got the low at 2750, 2350. And that's your range right now. And until there's something robust, and I don't know that a trade deal would be it, but you know, my feeling on the trade deal, I don't know how you guys feel, but you know, you got a guy, Trump, who's negotiating with two guys, Xi and Kim, one on different factors, that both have job security. I mean, those guys aren't going anywhere. Whereas Trump is not only under siege on his current term, but there's no assurance he's going to get past the next term. So how much negotiate? How much are you going to give up to somebody who you don't think is going to be there, who also has a history of reneging on the deals that have been made, you know, and try to get out of deals that have been made? And then basically how much are you going to give up? And I would say, you know, I don't think they're going to give up very much. I think they'll wait this guy out and see what happens, certainly before they give away the ranch. And, you know, again, so that's how I see it. So there could be a trade deal and it could be something that is of a short-term nature that could give it a pop, but I don't know that's sustainable. And the tax cut where they repatriate money and all that kind of stuff, you know, most of that seems to have been factored into the market as well. So building a big case for 3,000 on the S&P right now is not that easy unless there's been a miscalculation like there was on GDP. You know, they were looking for fourth quarter GDP to be at 1.9% and it came in at 2.6. That's a 40% miss on GDP. So is what? That is a very big miscalculation. If they are miscalculating earnings and earnings were to come out of the blue and be much stronger than expected, that would be the ace that they'd have to play to get this hand up above 2,900. Other than that, I just don't see so much happening because I think everyone's saying the Fed's gone, right? They're not going to hike. There's no way. Everything's too weak. No way. Well, if those inflationary numbers that are happening to wages trickle down over into prices, and I think they're going to do that, then this Fed's going to be back in the picture in the second half of this year, and people are going to have a big mouth open catching mosquitoes in the summer when they see that the Fed has changed their tune again, because they are data dependent, and the data on wages is indisputable, rising faster than the Fed funds rate. And that's not what the Fed likes to see. And again, as I go around and live my life, I don't know how you guys are feeling, but I see prices on things that I buy all the time going up. And if that starts getting reflected, then that's going to be a situation. The other thing is retail sales were weak in December. Everybody's got a job, so people are going out to shop. They're just not shopping for a tremendous amount of items, I guess. Well, what would you do as a businessman if you knew everyone has money because they're working, but they're not shopping as much as they are? Well, the items they are buying, wouldn't you increase their price? And that would be inflationary. And why would you increase their price? They use the common math. If I'm down 10% in sales and I increase prices, I can make up that 10% drop in sales by hiking the price. I think that's what's going to happen. I think that's my bet so far. And I'm going to stick with that until we start seeing some data that would totally make that irrelevant, and I don't see that just yet. One of the things would be interest rates. If the bond on the 10-year, which I'll get to in a minute, starts breaking under 2.4, then all bets are off. We probably have a recession coming or something weird happening, and then you'd want to be very careful on risk assets, because if the bond market can't handle a yield above 2.4, then that could be telling how weak it is, or something's going on out there that is causing a lot of concern for deflation or for a weak economy. All right, that's basically my overview on that kind of stuff. Let's go over these markets and give you a little bit of an idea. Let's start out with the guys just looking for income. Okay, so I'm going to give you some ideas here. First, you look at the 10-year note. Now, I still see the 2-year and the 5-year inverted. So I don't know what people are thinking, but I think it's still a little bit tight out there as far as the short end money. And right now, you're looking at the 10-year note, and you can see this 2.6 area is going to be very important. And the 2.8 area is very important. If you get about above 2.8, I think we're going to go to that 3%. And that's going to shock people, because the risk on this thing right now still seems to be for higher rates, because everybody who thought higher rates were going, you see this, higher rates, right? Then this is interest rates going from 2.8 on the 10-year up here. And now look at that drop. Ooh, so those yields have collapsed. So if you were bearish, meaning thinking rates were going to higher, you got blown out during this drop. So you're probably not in there anymore, right? So now everybody's out of their interest rates are going to rise trade, right? So we got the whole stage set for what? If everybody's out of the interest rates are going to go up trade, and it starts going up, they're going to come back in. And all these people that are long the bond market, right? They bought into bonds because bonds are going up, because interest rates are going down. What are they going to do if we get above 2.8? They're going to wait to see if we get to 3.2? No, they're going to start selling. And if you start selling the bond market because rates are going higher and the sellers are not there, you are going to be able to gap up a little bit. And so look at this area. Not yet, obviously. It's still the path of least resistance right now is for lower yields, right? Lower yields. But I'm saying be aware and be flexible. If it starts getting above 2.8, you better change your tune, because something might be happening. Wages might be even going up faster in months ahead. And the inflationary numbers could change. And I think then Powell would have the excuse to do what he wants to do, which is shrink that balance sheet that rose to $4.5 trillion during QE from $1 trillion. That's a lot of money out there, and that's why they're trying to get it back under control. So they'd like to shrink the balance sheet and normalize interest, and normalize interest in the Fed funds is supposed to be between where we are now, 2.25% and 3%. So back and forth in that area. So again, watch this market here. If you're in fixed income right now, you're doing pretty good, because you've had a nice 2-month rise in your bond values, but that party could come to an end if we get above 2.8. Okay, what about high yield? Junk bonds. For some reason, junk became gold in the first 2 months of this year. Just looking at HYG, that's a high yield bond. Okay, look at it. It went all the way down from 87 area, 86 area, all the way down to 79 during December. Hey, listen, if the stock market's collapsing, corporate bonds don't look very good, right? Those are the guys who owe you the money. When you buy a corporate bond, you're loaning money to companies. If companies are tanking, does that make you feel comfortable that their loans will be repaid? I don't think so. That's why it went in the toilet, right? But big rebound in stock, big rebound in fixed income on high yield bonds, yielding here 5.4. Obviously, you're not getting 5.4 because there's no risk. So obviously, the risk is this thing's going to come back down. And there is some gaps down here at 81, and down there in between 80, 82.5 and 82.75. So are we going to come down and fill that? If the stock market is going to have a 7 to 10% correction, yes, we will come down and fill that, I think. If it's not, then you're okay. Again, if we get a new high above 2,800 on the S&P, you'll probably be able to take out 86 on the high yield bond fund here, in my view. Now, stock market was at 2820. If you get a 7% correction, where are you going? You're going down about 2625. If you get a 10% correction, where are you going? If you get a 10% correction, you are going to go down towards, one moment here. Let's do a little calculation. Where are you going? You're going to be going down towards 2550. Okay, ballpark areas, right? So let's go take a look here. at the S&P. And on the S&P, you're down 15 today. You were down as much as about 25, 27. So the market has rolled over, but it has not. It has not collapsed. It's hanging in there pretty good, but it is in the corrective stage right now. The 200-day moving average on the S&P is 2750. So getting back above that would be helpful. If it stays underneath that, then again, going down to those lower numbers that I just mentioned are not off the table by any means. Again, looks like a lot of support at 2600. So that would be a number as well to keep an eye on. Again, a couple of things that I get tips on, is transports. Okay. I look at the transports. I figure when they stop losing confidence in moving goods and services, et cetera, they're probably losing confidence in the economy. Now we're down pretty hard again today, down to 10,071. I thought 9,400 would be an area that this thing could go down to. Look at the what do you call it? Look at the market here. Yeah, way down 11,000. You see, when it started to break on the transports, which is, let's see what the date is here. That was my tip, that it was what? That it was starting to break on the market in general, right? So that's like in the beginning of December, right? You start losing altitude in the transports. And, if you look at the tip and you get out, you're okay. But if you want to be a tough guy and hang in there, that's what you sometimes have to get into. Okay. Now, obviously, big rally up. So once this thing started going back up right around the end of December, there's your indicator that the broad stock market may be going as well. Now, when did this thing top out? About the middle of February, right? That's giving you the tip that the market's running out of some steam. Even though the S&P went up and made a new high, transports didn't. And so that's your divergence, and that's your signal that this thing is rolling over. Right now, it is coming into some support today at 10,010. So it could get a bounce out of here. Okay. There is some support. You see that high? You see that low? Okay. That's not coincidental. And so basically look for a possibility of a bounce here. And then if the news continues to be not so good, maybe further downside. That's the first one. The second one I look at is the Russell. Why the Russell? Because it's 2,000 stocks. That's a pretty big universe. And these guys do well, when interest rates are friendly. And when, business is booming. Now, let's take a look at the Russell. Russell, definitely similar to the transports. Gave you the idea that it peaked out. What days? Let's see. Yeah, the Russell peaked out in November. And then it had a little lousy rally in December, nowhere near that high there. So this thing was weak, telling you all the time. Once it broke underneath these lows of 1475, obviously it was timber. And there you go. There goes the tree right into the toilet, right? Now look at the rally we've had all the way up to 2,600, 1,600. Look at the moving averages. Boom, 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 boom. I mean, look at the tops there. Okay. And then it topped out at the end of February. Had a little rally, couldn't take out the high. S&P rallied, made a high, and then boom, we're back down. So this thing has been a very good indicator. Again, it is now hitting some support at 1,500. Today's low 1,510. Okay, but that little hook at the bottom here. If next week it doesn't get taken out, it could be an indicator of a little bit of a bounce back. Okay, but the thing is that it is definitely on the defensive again, and that's the key. The market is on the defensive, not on the offensive right now. Okay, so I give you a little insight there on a couple of different things that I watch. Again, the strategy called married puts and collars are what I suggest people investigate in order to protect their equity. You understand? I'll give you a good example. I gave an example to people on Boeing. Okay, now I'll give you this is a good example. Boeing today is at 419. I gave this example when it was up near 440. Okay, it's not at 420, and I'll tell you why. When we were at 440, 446, near the high recently, I'll tell you where the high was. The high was only a few days ago, March 1st. Okay, so last couple of weeks, right? We go to 446. Look at the 200-day average, 356. Let's do a calculation. 446 minus 356 is $90. Divided into 356, you're 25% on a company that's 238 billion, which means it's a monster. It's a monster company. And you are 25% above the 200-day average. That's overbought. And so if you have a nice gain in there, what you can consider is a collar strategy. And in this strategy, hypothetically, generically, I'm going to explain. If you would sell the 470 call and bring in, let's say, $3, and take that money and buy a 430 put when it was at 440 with the $3 you got on the call. So you took the premium out of the call at 470 and you bought the put at 430. Well, now the company's trading 419. So you were actually sold. You have a right to sell at 430. So if this thing falls all the way back down into the 300s, you've protected your equity up at 430. And you didn't come out of pocket for it as much as used cash flow from one investment to another. So yes, if it stays underneath the 430, the 470 will go to zero if it expires underneath that level, and the 430 would expire at zero. But Peter paid Paul, and now you've got at least the ability to have the right to sell at 430 until the options expire. So again, that's called collaring it. And if you don't understand it, or you want to talk about it, or you've got something out there that you're concerned about and you want to see what alternatives might be in front for you, again, I'm more than willing to answer a question if I can. OptionProfessor@gmail.com. Again, if you have friends or associates that are not doing that well on their stock portfolios, or they are in a situation where they'd like to protect themselves from market declines and they want to learn more, either A, have them come to the webinar or the podcast here at OptionProfessor.com, or go to the email and just shoot me an email and I can correspond. OptionProfessor@gmail.com. Okay, so there's a couple of things there that I think are very timely. And for gosh sake, I've been doing this stuff for decades. Hedging is a tool. You can use it at any point you want, but knowing how to use that tool from time to time is very valuable. I mean, think of all the equity that's been lost in Apple. Think of all the equity that's been lost in Amazon. Another time I mentioned about hedging was with Amazon. Let me show you that real quick because I think this is timely, and then I'll get into the other markets real quick. Amazon. Okay. Amazon is at 1,600 right now. It was up at, look at the high, 2050. Okay. Let me show you something here. When we were up at 2050, okay, the moving average on the Amazon was at 1,550. So you take 2050 minus your 1,550, and what do you get? You get about $500 into 2050. That's again 25%, just like Boeing, 25% above the 200-day average. And this is you thought Boeing was a monster. This thing's 800 billion. It's 3 times Boeing, and you got 25% above the 200-day average. That's not going to last, in my opinion, and that's the time you want to make sure you do a little hedging. Now, right now, the moving average has gone from 1,500 to 1,700, but can you notice the stock is back underneath the average, and the averages are inverted? That's why I say this stock market rally was very fast and furious because it looked like the Fed made a big pivot. And so everyone thinks that there's no cops on the highway. Everyone started driving 100 miles an hour. Now the cops are starting pulling people over, right? It's not going up anymore right now. Now, here's the deal. You've got an inverted situation there. So keep an eye on the 200-day average. If Amazon can get back above 1719, it might be interesting. If it can't do that, you certainly aren't going any higher. So ergo, be careful of these things until they get at least back above the 200-day average. Other than that, you might be catching a falling knife, and that can be a painful operation. All right, let's go around the horn, as they say, and give you some other stuff that's going on in the world. Okay, we went over the S&P, and let's see what else we can go over. Let's go over the dollar. Trump wants the dollar down. Huh? I don't want a strong dollar. This is a guy who's had how many bankruptcies? So you got to be careful. Anyway, you got 97 point what on the 97.39. My feeling has been that the dollar has resistance at 98. So as long as it stays under 98, and if it can get under 95, 94, that's when I'll get bearish on the dollar, when it gets under 95, 94. Because I'm not interested in the bunny hops here. I'm trying to find out the trend. And the trend right now has been sideways. And the longer you go sideways, when it breaks out of that range, the bigger the move. So right now we've been kind of 95, 98, 3-point move for months and months and months. So if it breaks above 98, the move should be substantial. And if it breaks under 95, or 94, the move should be substantial as well. And that could correlate into a bunch of different things. But anyway, so the dollar has picked up steam. Now, something that I brought to your attention and I've been monitoring are the gold stocks. Okay, here's GDX. Okay, brought it to your attention when we're down at 1719. Why did I do that? Because look, you see the low there? Now we don't see a new low for a month, right? That's the time you start taking a bite and you put your stop underneath the 17, right? So now you take a bite. Blows out those highs, you take a little more bite on the pullback when it doesn't take out those lows. Goes up, pulls back, doesn't take out that low, you take another bite. Pulls back, boom, take another bite. Goes new high, pulls back, take another bite. Okay, now we get up here, and as I told you last week and the week before, you're extended on the gold shares. And if the dollar is going to pick up steam, which it has, then the gold is going to take a break. And that's what it has done. And it came down from here to here. Now, could this be an area to take another bite? It may be. That would be a good place to put a stop underneath 2150 or whatever that low is here and see if it can keep going. I heard that George Soros is doing a whole bunch of buying into gold. I don't know if that means anything. I know there's a lot of mergers and acquisitions going on here, or at least talk about them. You got Barrick trying to buy Newmont, and you've got Freeport-McMoRan buying Goldcorp. So obviously these guys are thinking that their stocks are undervalued, and that's why they're trying to buy them. So at any rate, if the dollar were to start dropping and inflation on the wages bleeds over to the CPI and we get going further here, this could be the sector that you'd want to have part of your capital in. Now let's look at the moving averages and see if they're helpful or hurtful. We're at 22 right now. Let's look at the moving averages. The 50-day average is at 21.25 and the 200 days at 20.48. They got the golden cross going on the upside. So that's why I'm saying this low area of 20 to 21, if it can hold, this should be a pullback that might be a value to buy, providing the dollar doesn't take out 98. If it does that, I think the gold may go back further. But right now, it has been a good winner. And again, we did suggest lightening up or hedging when we were up at that high point. Because again, you can see 25 is a resistance zone, 25, 25, 25, and 17, 25 and 18. So again, this is a resistance zone. That's why sometimes you hedge by using the collar or married puts when you get to the resistance zone. That's what I talked about last week. That's what I'm talking about right now. Okay. All right. And one other thing that's supposed to be tariff oriented, because they're supposed to be buying our natural gas and our soybeans. Again, they probably have other sources for soybeans. There's an entire continent called South America that has a heck of a lot of soybeans. And you know what? We're not going to be able to hold them hostage to buy our soybeans when South America's prices may even be better than ours. But at any rate, this is what I've been looking at just in case it was going to make some kind of a move. But it's been a loser so far, no doubt about it. So there's nothing happening yet. But I am going to show you here on the chart if we get a deal and we get above 950, which is what I've been telling you for a while, then you got something cooking. Again, right now, it's just it can't get out of its own way. Pops up, goes down, pops up, goes down. And there you go. So one last thing before I take off is China. Again, China's coming off a little bit as well. And I was very, very strong on Alibaba when it was way down. Let's take a look at Baba and give you a quick look here, because again, this is one of the Cadillacs of their stock market. If you notice, again, we were way. Oh, and by the way, I'll show you exactly why I was strong on it down in the 130, 140 area. And that was, at the beginning of the year and last year. I'll tell you why, because I'll show you the moving averages. But again, you go up to 190, it's time to hedge. It's time to do a married put. Hold on a second here. Okay, this is the last thing I'll be able to go over. So there you go. Okay, the Alibaba moving average was 167. In December, it was up at like 175. If you have a stock that's trading at 130 and the moving average is at 175, okay, let me help you with the math again. You're $45 underneath the moving average. Divided into the 175, You are 25% underneath. Again, 25% is in the zone called overdone. Okay. So you're oversold on the downside with a company that's 456 billion. Again, another monster. When you get a monster that's 25, 30% under or over its moving average, that's very, very significant. So that's where you take a bite, either on limited risk options or take a position with a stop or take a position with a married put or something. And now you've gotten a big rally and you rallied all the way up towards 190. Okay. So now you're rolling back over. Again, this market came very fast. Again, sloppy moving average. You got a golden cross to the downside here, 158 and 167. So after you've got that situation on the moving averages and you get some crazy move to the upside, the likelihood is going to stabilize or pull back, which is exactly what's going on right now. Okay, that's all I can give you today. And again, I just recommend that you tell people to get to this meeting once a week and to shoot me an email if they want to discuss anything particular. Again, the website, OptionProfessor.com, and the email, OptionProfessor@gmail.com. Okay, let's stay in touch, guys. I'm on top of it for you. You try to take the information and try to put it into your mix. And hopefully some of this stuff will have some added value. That's what I try to do every week. Until next Friday, good luck and good trading, and have a great weekend.